I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
We've got the inside scoop from none other than the billionaire real estate investor Barry Sternlicht, who's sounding the alarm bells about what he calls a Category 5 hurricane hitting the real estate market. Sternlicht is a man who needs no introduction in the realm of real estate. Now, hurricanes in real estate aren't new. We've seen booms and busts, bubbles and crashes. But what Sternlicht is talking about is something different, something more sinister, something that he says is looming over the entire real estate industry like a dark cloud. This isn't a localized event or a short-term setback that we're talking about. Sternlicht likens it to a widespread blackout, a situation where the entire industry is in the dark, left to guess, speculate, and fear what might come next. It's a state of uncertainty, of unpredictability that, according to Sternlicht, has never been witnessed before in the history of real estate.
So you are one of the best known and one of the best real estate investors in our country. Right now, many people think the real estate market's going to be in trouble because high interest rates are making it more and more difficult for people to service their loans, and we're going to have a lot of defaults soon. What do you think about that observation?
Anything with a fixed income stream is worth less when rates rise. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate, and the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
So what's causing this hurricane? Barry Sternlicht, a leading real estate investor, believes the answer lies in rising interest rates and the Federal Reserve's increasing efforts to slow down the economy. In the world of real estate investing, a vital and often complex relationship exists between values and interest rates. This relationship impacts not just the property owners and investors, but the overall health of the economy as well. It's the pulse that drives the market, a delicate balance of supply and demand, as well as risk and reward. Imagine, for instance, that you own an apartment building. This building, like many properties, generates a fixed income stream. It's a reliable source of income, providing stability for the owner and contributing to the broader economy. But what happens when interest rates start to rise? As interest rates increase, the value of that property can take a significant hit. It's direct correlation. As one goes up, the other often goes down. This is because as the cost of borrowing rises, fewer people can afford to take out loans or mortgages. This reduces demand, which in turn causes property values to fall. And this, Sternlicht believes, is where we find ourselves right now, in the eye of the storm. To further illustrate this point, let's suppose that as interest rates go up, the present value of future cash flows from a property goes down. This is because the money that an investor expects to receive in the future is worth less when interest rates are high. It's a fundamental principle of finance known as the time value of money.
Your view is because of the kind of things you see coming, we will go into a recession in the United States, in your view?
Yeah.
And any way to avoid it at this point, or not really?
It's interesting. One of my friends had a meeting with one of the governors recently, last week. And they're like, we hear all this noise about the real estate, but we don't see the issues. They're going to come, and there is going to be a serious credit contraction. The country, in any asset class, has not adjusted to that cost of capital yet, but it's coming. The economy will slow. You can see the numbers. CO confidence is down, consumer confidence is down, retail sales are down, service economy is wickedly strong. It feels like the last gasp before we actually settle into what should be what you'd expect to be. I hope it's a shallow recession. I hope he can pull that off.
Normally when you increase interest rates, you decrease GDP growth and you increase unemployment. Your point is unemployment's not going up because the statistics aren't really covering the people who are really being laid off?
Unemployment isn't going up because structurally interest rates aren't affecting the labor market the way they would normally affect the labor market. You have the offset in construction from the infrastructure bill, and you have the service sector, which is still recovering from the pandemic, which normally would be tilting over.
He foresees a recession looming in the near future, casting a shadow over the bustling economic landscape. This isn't just a blind assertion, rather, Sternlicht bases his prediction on various critical indicators that he deems are potent enough to cause an upheaval in the current market trends. One such indicator is the trend of decreasing consumer confidence. Sternlicht explains that when consumer confidence wanes, it inevitably spells trouble for the economy. The consumers about the state of the economy profoundly impacts their spending behavior. As their confidence dwindles, they become less inclined to spend. This reduced spending in turn leads to a decrease in demand, which can have a domino effect on businesses and industries, eventually leading to a slowdown in the economy.
So this is a US situation. In the US, you have two markets. You have the really nice buildings that are ESG compliant, that are lovely, like the one we're sitting in. This place is buzzing, and they're back because it's a fun place to be. And if you're in a building with lots of cubicles and it's dark and there's no life and love, so nice buildings, even in a city as currently destitute as San Francisco from an office market perspective, the best buildings are still leased. And so you're going to see a bifurcation of the market in office. The nice buildings will stay rented, and my guess is at pretty good rates. And the B and C stuff is going to be maybe fields of grain or something. It'll be very pretty. We'll have all these little mid-block parks in New York City because there won't be anything else to do with those buildings. And nobody will carry them because there's no hope. Some of the cities that have issues on commuting, like New York or LA downtown, San Francisco, the CBD, that are difficult to commute to, that's where the pressure's so hard from workers saying, I don't want to drive into the city an hour and a half and drive home an hour and a half every day. But I also think a nice little recession will clear this, and you'll see people come back to the office. And I was in your town, take the Amazon HQ2, they're expecting people in those offices 4 days a week come the fall. So the other thing about office, David, is AI. AI is going to hit a couple of these industries that have been big users of office space.
Another important signal Sternlicht refers to is the slowing down of retail sales, which have been on a declining trend. This slowing pace hints at less consumer spending, which is a pivotal factor for economic growth. Sternlicht explains that a fall in retail sales means consumers are either saving more or paying off debts, both of which can have a negative impact on the economy. He further highlights the impact of the Federal Reserve's measures. The Federal Reserve, as the nation's central bank, plays a significant role in the economy. Sternlicht emphasizes how its policies can either make or break the economy.